Now let's talk about the concept of hedging risk exposure. So by definition, hedging is used to increase the financial stability, and it assists organization in reducing the risk of financial distress. So basically, if we have an exposure in copper related product and we see that the price of copper is actually volatile, so what we'll do, we will purchase copper in advance. So basically, if we are here at time 0 and this is 6 months and this is 1 year, if the current price of the copper is $100 per unit, we expect the price to increase to $125 in 6 months and $150 in 1 year. What we can do is that we can purchase such financial products which would allow us to purchase copper in advance while standing here. One of the common products that we use is commodity futures. So what we'll do is that we'll make a payment here and we will book our copper to be delivered or to be transact in 1 year. The price of the forward future or forward contract would be higher than what we have currently as of today, but it may be lower than what we have in a 1 year period. So for example, we can book a 6-month forward at a rate of $115 per unit, or we can book a 1 year contract at $130 per unit. Of course, you'll have to pay some fees for that bit, and there's some volatility involved, that what if the price actually don't increase, it may actually go down from $100 to $90. So there's a lot of expectation of your own company and the expectation of the market that goes into hedging your positions. But the idea is to keep a position that will allow you to protect yourself from the volatilities in the financial market. The same goes for the stock market. So we can assume that we can purchase future stock for 3 months at a rate of $115 per share, and the same theory would be applicable to purchasing the stock as well. The product may differ from futures. We may consider different financial products for the stock market, but the mechanism of hedging would remain same. That is, we try to minimize our losses that we can face from fluctuation in the financial market. Now, with the advancement in the financial markets, we can hedge almost all of our risk. But in practice, not all of the risks are hedged. So basically, there are certain investors and there are certain market where hedging is not performed because the manufacturer has the ability to pass the risk to the other parties. For example, if there's a car manufacturer which can transfer the prices of change in the raw material or change in the currency to the ultimate buyer. If that is the case, the manufacturer would not be interested in doing the hedging because he has the ability to pass its price to the ultimate buyer and does not face any sort of risk in it. Another example is of a gasoline company. If they have the option to pass the price to the customers, then they would not be doing the hedging. And it's also depend from industry to industry. So if there are 10 such companies and none of the companies are doing hedging and they are just transferring price to their customers, then none of the companies would be doing hedging because of this ability. But in the financial world, we have this risk that we are exposed to as an organization, and to be able to save us from volatility, we do that hedging. Another product which is used for risk transfer is insurance, where you pay a premium to an insurance company and you get some sort of promise that you'll be paid an amount if certain event happens. But that insurance is generally considered to be a costly exercise, and it's directly related to the amount of risk that you are taking. On the other hand, hedging or the use of derivatives is considered to be economical. It's considered to be cheaper than the insurance, and its applicability, its implementation is also considered to be simpler than what we do in insurance. Now let's talk about some of the advantages and disadvantages of hedging in both practice and theory. So before we discuss the advantage of hedging, let me tell you a scenario of how hedging is used. So coming from the earlier example that I just quoted regarding the copper company. So let's suppose there's a manufacturer, there's a car manufacturer. Of course, this is hypothetical, but there's a car manufacturer where the steel goes as raw material. Now the price of steel keeps varying. So if we are at 2018, 2019, 2020, 2021, the price of the car actually depends on the raw material. Let it be steel, let it be the commodity, the engine that is going in. But let's make it specific to steel only, and let's assume that about 20% of the cost of goods sold, that the amount that goes to making the car, comes from steel. Of course, in reality it may vary, but let's just assume that it's one of the major costs. Now, if the price of the car is $100,000 today, you will have to make some adjustment to keep your price intact in coming years. Of course, you do it to manage the market, to have the right sort of competition with your competitors. So you want to have a transitional increase in your prices. So you have decided that you will be implementing some 10% increase annually, and it may go up to $1,10,000, then $1,20,000, then $1,30,000. So you have made this strategy while standing here. Now the steel prices were $100 here per unit, and you expect the price to remain in a certain range. For example, you have expected to remain 110 here, 120 here, and 130 per unit here. Now if there is sudden changes in the steel market and price goes from $100 to $150 in year from 2018 to 2019, then your product price would be increased significantly as well. In order to save yourself from that bet, what you do hedging. You hedge your steel prices, you purchase your steel in advance from the commodity markets using some financial products. In most cases it can either be a forward or a future, and you hedge it at 115, 125 and 135. Now if you have done that hedging, irrespective of where this price go, even if it increased to $200, you are safe at least during this period, and you can have this constant increase in the prices as opposed to abruptly increase your pricing based on the increase in prices of the raw material. And hence you can have more customers, you don't lose your market, and your cash flows and your bottom line, your profitability would also remain intact. Now this is one of the significant advantages of hedging, which is further divided here in these pointers. So the first advantage is that your cost of capital become lower. How? Basically, a lot of things are tagged to what sort of sustainability, what sort of stability you have in your organization. So if your bottom line, if your profitability, if your cash flows is stable, thanks to the hedging you did, the capital provider would see that you have a stable profitability, you have a stable cash flow, and you have actually been performing and you have been posting good growth in your bottom line despite the abrupt changes in your raw material. And the capital provider will have more confidence on your strategy, and he will not be concerned about the risk that you'll be facing. And since the perceived risk would be lower, the cost of capital would be lower as well. Due to this fact, since you have a stable operation, your debt capacity would also increase because your volatility in your earning and your cash flows is actually lower. It also provides safe investment option as well. People are actually willing to invest in your organization, and you have more capital availability option, capital injection options. Now, since your cash flows are non-volatile, it's smooth, it's working despite the changes in the economic growth, you will have less restrictions on your debt. So basically, a debt covenant is a concept. So whoever is lending you money, he comes up with a certain number of check and balances that they want to keep on your organization. For example, they would say that your return on assets should be at a certain level, your return on equity would be at a certain level, your profitability would be at a certain level. So basically, if you have non-volatile cash flows, these covenants would be relaxed and you'll be able to get better debt at good terms. Second is that you will have better cash flow management. This example is largely an example of cash flows where you are managing your cost, and in essence you're managing your product price, and in essence ultimately managing your profitability. So it's more than just risk transfer. You are actually making money. You are making a stable income out of hedging. If you have smoother revenues, your tax liability would be smoothing out. It will be declining on a timeline basis because your revenue is increasing, and there's not a lot of volatility. Basically, we won't say be declining, but you have a stable tax liability as well, and which is manageable based on the operations that you have. This stability in your numbers, in your financial, also provide stability in operations for your stakeholders. So basically, the lenders, the customers, the suppliers, they trust your organization. They are not concerned about the operations. They don't see any significant risk, and this reputation actually leads to increase in your stock and your ultimate value at the stock market. Then from a management perspective, it also becomes easier to do business planning because you have actually come up with a way of managing your volatility. So volatility is the thing which actually impacts everything. So if there is volatility in the raw material, if there is volatility in the financial markets, in the investment you have made, if you have hedged them in an effective manner, you will be able to do your business planning you'll be able to do your business planning in a better way. And manager also posts better revenues, which actually ultimately increase confidence and compensation for staff, which ultimately leads to increased profitability. While it is considered a long-term thing, hedging also assists us in achieving short-term targets. So basically, if there is a short-term volatility for about 3 months and you had not seen something coming, so you had already hedged steel prices, but you may not have you have not hedged the foreign currency movements in the long run, you may do it for short term as well. So the financial products are available for 1 month, for 3 months as well. So you can do it for a longer term period, but you can also hedge your exposures for a short term and assist organization in meeting the short term targets as well. Again, as discussed earlier, hedging is a derivative instrument and it is cheaper than the insurance policy because the premium that we pay for the derivatives are way lesser than the premium that we pay for insurance company. Now let's talk about some of the disadvantages that we have for hedging. So number one is unplanned cost. So basically what happens is that you did hedging for steel and you expected the premium to remain around 1% of the overall transaction. but due to some regulatory changes, your premium that you have to pay increased from 1% to 2%. So your planned cost would be significantly different from what you earlier expected. The second disadvantage is that the firm may lose its focus on core business, and that may lead to losses. So you were actually hedging steel prices to manage volatility, but you end up making profit from the derivative market in the steel prices, and you see that as an opportunity, and you say that it's good to do hedging, but we can also do some speculation there, and we can earn some extra money while doing the trading. And since we are in the market, we have the advantage there as well, and you end up taking some positions which you were not supposed to take. Initially you make some money out of it, but then ultimately you lose your focus from the core business, and you end up making losses on your actual product as well. And then maybe there are changes in the speculation market as well, and you make losses there as well. So hedging may lead to lack of focus on your cost of business. The next one is that there's a compliance cost involved as well. So you need to disclose your hedging exposure in your financial statements. It has to be presented in a certain way, for which you need a certain trained staff. You have to see the auditing practices. Who are the auditors? Are they aware of the hedging practices and the derivative markets? Then who will be monitoring it? So as we discussed earlier, derivative market or hedging involves some complex processes as well. So basically you are just going to make money out of it, or doing some hedging there, but you end up putting into some complex transaction where you did not foresee some sort of risk, and that particular risk that you didn't actually account for end up in losses again. So the compliance cost is something that is very critical. Complexity, again, I have just explained that there is derivative complexity, and you can build a lot of leverage while building in the derivative market, and it may increase the assumed risk. The next point is that for the derivative pricing, for the derivative markets, we use certain models to price our derivatives. Now, some of the assumptions that go into those models are actually unrealistic. And by unrealistic, I mean that you may have calculated that the risk is actually $1 million only, and you did hedging. But it turned out that in the actual world, there were transaction charges, there were tax involved, and your risk was actually not $1 million, but it was actually $10 million. And hence you end up losing money on the unhedged position that you have had. Similarly, models like CAPM, which is used to quantify the shares, also talk about systematic and unsystematic risk. So systematic risk is the risk which is related to the financial market that cannot be diversified away, but the unsystematic risk is something that is related to the company, and we can diversify it through diverse investment. Again, this diversification, this assumption of diversification is not realistic, because in the real world you will be putting a lot of cost in terms of transactions if you are moving from one share to another. And hence the pricing that you will do on your share, which will be ultimately used for hedging, may not reflect the real market prices, and you may not be hedging your portion well. So that's one of the disadvantages. That is the complexity and the involvement of a certain number of models, which has some significant theoretical assumptions. So both of these points, these ones are actually related to the theoretical foundation of hedging. Now, next point is that hedging is considered to be a zero-sum game. By zero-sum game we mean that if there's a party A and there's a party B, if party A is gaining $10, party B will be losing $10. Or, in a sense, if you are managing it from 2018 to 2022, if you are making a profit here and a loss here, the combined position that you will have during this particular year will be zero. Like if you are getting advantage of the hedging from on one year, you can lose money on another year, and if you smoothing it out over a period of time, the result would be zero. But of course, this can be one of the disadvantages. You may see that that you are making money out of it, but in actuality, in the long term, you may not be making a lot of profit out of it. Again, this is a theoretical point, and we actually make some money out of it. Hedging has, of course, its own advantages, but theoretically, it is actually challenged that it's actually a zero-sum game. And in the last, the derivative pricing is extremely complex, and it's not as easy as equity and bond pricing. As a result, the derivative pricing may not increase all sort of risk factors, and we may end up missing some risk that can be disadvantageous for us.